Hey guys, Matt Brunig here. I wanted to do a video about personal finance, or a series of videos, really. I know I've been talking about that for a while, and it just seems like an area I might be able to shed some light on. It seems like something a lot of people are interested in. I get tweets about it all the time. So let's go ahead and dive right into that subject. Today's video is just going to be a kind of a general starting point, way, a framework for understanding personal finance as I understand it. And then from there, I'm hoping people will leave comments, with specific questions and stuff like that that I could jump into. That seems like a natural course of doing things. So let's hop in. So for starters, I've consumed a lot of personal finance content over the years. Even as a kid, I would listen to it on the AM radio. I've always been very intrigued by it for one reason or another. I guess because it involves money and it involves, issues related to like income stability and income security and things like that, which I'm interested in. That's one of my main policy interests, though. In the policy world, I think about how to design a society with those things, whereas the personal finance world is very much, how to somehow personally achieve those things for yourself. So, in that content, I actually find that content tends to focus on three different people, three kinds of people, three groups of people, though the content doesn't always distinguish between these people, helpfully. So I think it's useful to do that up front, right? So first you have people who just, they're poor, and I don't necessarily mean poor as in under the poverty line, but their income and assets are so low, right now that there's really not much they can do to save or anything like that, because they need to put all their money towards just meeting their basic consumption needs. And if you watch the personal finance people deal with those people, like if they have like a call-in show or whatever, they always tell them, you got to earn more. You got to earn more. As always, Dave Ramsey, you got to earn more. And I always find that advice really, I don't know, it's just very funny to be like, you know what you should do is you should just get paid more at your job. And it's like, okay, well, I don't really set my pay. That's not how this works. You know how the system works? The people they own and they set the pay. And, I could try maybe to get a little more, but it's like I push a button and my pay goes up. What I would actually do, but I get why they do that, right? Because look, you can tell them, hey, you need to join a socialist movement or a union or something like that. But, if you're just trying to say, hey, look, the system is what it is, what can you personally do? Well, at this level of income, there's not a whole lot you can do, so you got to somehow get that income higher, right? I think I get what they're doing. It comes off as a little bit insensitive in some cases. But I would also add on to it, and I wish more personal finance people would do this, would be to say, hey, make sure you go and claim all your benefits that you're eligible for, whether food stamps, Medicaid, tax credits. Those are going to be the big ones. Like some 30% of people who are eligible for those things don't sign up, and that might be you. So go check it out. And of course, like local charity and stuff, though that's very fine-grained and hard to advise generally about because it kind of depends where you are. The second group of people that they deal with are compulsive spenders. And this actually, I think, the majority of personal finance content where they're dealing with clients or like particular people, they're mostly dealing with compulsive spenders. There was a series on Netflix that just came out. I forget what it was called. And everyone he dealt with in the show, it was a personal finance series. Everyone he dealt with in the show was a compulsive spender. I think there may have been one exception, but it was all just compulsive spenders. And that makes sense for content because you kind of have a sort of like, like a hoarder's element to it. There's like a freak show element to it where you're like, look at this person. They're so stupid. They have all these problems. They live such an extreme life. They're out of control and whatever. Now, for those kinds of individuals, the issue is not really information. They may know like, well, yeah, I should spend less and save more, whatever. But it's just like that compulsion to buy, they see something, they get something, emailed to them. There's a sale. the money's in the account, or they have a credit card, access, and they see stuff and they just can't control their desire to buy. And I'm very sympathetic to those people. Like compulsions, occur across a wide range of things, whether it's alcohol, gambling, food. I can fully sympathize with people who are in these kind of compulsive / addictive situations. But that's not really, that's behavioral modification around compulsive behaviors seems to be a little bit outside of the expertise of a personal finance person who you think, like you're not a psychologist, you're not, or a therapist or whatever it is that you deal with to get over these kinds of things like rehabilitation or whatever. So I'm not really going to focus on, how to help people who have compulsive spending problems, even though I sympathize. What the fuck do I know about that? So the last group of people then is everyone else, right? People who they have some money, so it's not like they're too poor to save, and they know, they don't have compulsive spending problems. So their issue is just, okay, I want to save, but where do I save? What do I do with my savings dollars? And before getting into the specifics of that, I guess it's useful to start with a kind of general theory, of why save, right? And there are two main reasons. The first is consumption shocks, and the second is income shocks. So consumption shocks are, let me take a step back, right? Why do we need to save in the first place? What would be the problem just spending all the money that comes in, right? As long as you make sure that, hey, in a given month I have X amount of income, and you say in that given month I'm going to spend X amount of dollars, and you're good. As long as those two equal, there's no problem, right? We call that living paycheck to paycheck, but so what, right? We all gonna die one day, so just spend all the money that comes in. Like, what's the issue? And the issue there is just that like you have these shocks, right? So a car might break down, an appliance might need to be replaced, right? You have these spending shocks, these consumption shocks that are difficult to deal with if you spend all the money that you make, like in a given month. You're gonna have to have some reserves because your spending needs are lumpy, right? They don't all occur in a nice steady stream where every month it's the same spending needs. Some months you might have really big spending needs because something might happen that requires you to spend a lot of money, and so that's why you save for that. And then you have income shocks, which is sort of the other end of the ledger. Not that spending needs ramp up really quickly in a way that might not be manageable, but also that income can decline very rapidly in a way that's not necessarily manageable. And most of the time, income declines are going to come from job dislocations, whether you become unemployed, whether you become disabled, you need to take time off to deal with an illness or a family member or a newborn, or, of course, in old age, you might retire or whatever, right? So that's how you get those income shocks. And if you're living paycheck to paycheck, you're not going to be able to manage those. The final possibility there are bequests, right? Inheritances, but I'm not really going to focus on that. All right. Now, in understanding that consumption and income shocks are sort of the reason for saving, it's also useful to start with a recognition that a good welfare state should resolve most income and consumption shocks. That's one of the main cool things that the welfare state does, right? So take universal healthcare, for example. If you have a universal healthcare system with very low cost sharing, right, very low out-of-pocket expenses, then when you have health-related consumption shocks, you're taken care of. If all of a sudden some serious accident happens or you have some serious disease that requires tens of thousands, maybe hundreds of thousands of dollars of medical care, no problem, right? Because the universal healthcare system manages that for you. So you don't have to save for that, because that consumption shock, that specific consumption shock, is smoothed over by the system. Good to go. Same thing for child and student benefits, right? You don't need to save for college if college is managed, if the cost of college is subsidized socially. You don't need to worry about the extreme expenses of childcare or the health care for kids, or, you even in, a lot of systems, you get a check each month to take care of the kid, right? So the system smooths over those consumption shocks. And then you have the income replacement benefits like unemployment insurance, disability insurance, old age benefits, paid leave, right? These things do the same thing as well, right? They paper over income shocks. So in a good welfare state, like a really solid welfare state, you think about what would be the financial advice, what would be the personal finance advice. You would basically say, hey, open up a savings account and make sure you have enough money in it to cover things like, when you need a new dryer or something. Like that would kind of be the extent of it, right? Because all the other things are smoothed over by the welfare state. But we don't live in a good welfare state in the U.S., and so you got to do more than that. And personal finance is, to my mind, largely about filling the gaps of the welfare state by building up your personal net worth, right? So you create your own personal welfare state. And once your net worth is built up, you can access that net worth to resolve consumption and income shocks that the welfare state does not, right? You can spend down your savings, in other words, to manage these shocks that the welfare state doesn't manage for you. The personal welfare state understanding is not sort of purely an idiosyncratic creation of my own mind. It's fairly explicit in certain policy areas like individual retirement accounts, 529s for education, right? We have these, what I sometimes call welfare accounts, these like personal welfare accounts where you put money in each pot, and the pots are actually labeled by the welfare need, right? The 529 is for college education. The IRAs are for retirement. We even have there's something called an ABLE account that's for disabled children, right? So we create over time this, by the way, god-awful system, insanely complicated, doesn't really achieve its purpose at all. But, this system of welfare accounts where you put money in the different buckets, and instead of everyone contributing to a central welfare state and then receiving benefits when they become old or, need education or become sick or whatever, we all have our own little personal welfare accounts and we have to dole out our savings into it and whatever. And of course, we then get to celebrate, oh, the taxes are so low, except of course, with all the money you save on taxes, you then have to put it in one of these welfare accounts. So it's not like you really get to enjoy the lower taxes anyways. So if what you're going to do is build a personal welfare state by building up your personal net worth so you can then spend it down to paper over consumption and income shocks, the question becomes, how do I do that? How exactly do I build up my net worth? And in theory, the ideal way to do that is going to be to allocate marginal savings dollars towards paying off the debts and buying up the assets that generate the highest rates of return, right? So the idea here would be, okay, create a list of all the places that you can put savings dollars. And at the top of the list, you want the place that has the highest rate of return. And that might be a rate of return on an asset, or it might be an interest rate on a debt, because those are essentially equivalent, right? Every dollar you put on debt, you save, you get a return equal to the interest that you save. And every dollar that you put in an asset, you get a return equal to the actual return on the asset, whether it's a dividend or capital gain or interest or whatever. So the idea is you just create a list, right? And number one on the list is going to be the highest rate of return, the highest interest rate, whatever. And then number two is going to be the second highest. Number three is the third highest, and all the way down. And you just kind of allocate your dollars to those buckets in that order until you run out and you're like, I've got no more dollars to save. And then wherever you are on the list, you just stop. And then you wait till you get more dollars, and then you start the process over again. Now, in practice, this is complicated by the need for liquidity and by uncertainty and unclarity about rates of return. So if all the assets, if everywhere you put money was equally liquid, meaning that you could get the money back out whenever you needed it, then you would just do the theoretical thing and line up all the assets by, the highest return. The problem is that in order to use your personal net worth as a way to buffer yourself against consumption shocks and income shocks, you have to actually be able to readily access that net worth. But some things you put money towards, you're not able to do that. And in a lot of cases, that's because the policy itself is set up to make it where you can't do that, right? So if you put money in a retirement account because you're like, oh, great, I can get a good rate of return on this, especially because there are tax advantages to putting money in it and whatever, right? You do all of that, and then boom, the income shock hits. You lose your job. The consumption shock hits. You get a $10,000 medical surprise bill or whatever, and you got to cover all of that. Then you go and you're like, oh shit, okay, I want to take money out of my retirement account. Except you can't, because if you do it, you have to pay a huge penalty, and all the return that you got from putting, it all just gets negated by the penalty or whatever. So you have to now balance these considerations, right? You want it to be readily available, but also high yielding, and yet these two things are frequently at odds with one another. Again, often by explicit policy design. And then the other issue here is that there is unclarity about rates of return. You both have inherent uncertainty about rates of return, meaning that you don't know, you could look at the historical return of a particular asset class or whatever, but you don't know that whether that's going to continue to hold. And then there's also just unclarity because actually figuring out what the effective rate of return of a particular place of putting a marginal savings dollar is not straightforward, right? Because you have to calculate tax savings, employer matches, and that's not easy at all, right? The non-taxability of returns. Sometimes it's sensitive to your current income versus your future income. Like the edifice, again, that we've built up with these welfare accounts where you put savings dollars into the different kinds of accounts it's almost incalculable for even very sophisticated people, let alone regular people, to know, oh, this is the best bucket to put this dollar in. And it's frankly, like I said before, it's an insane way to try to manage this. But hey, it gives people a sense that I'm not taxed and I'm managing my own affairs and whatever. So, I wouldn't want to. I don't really like doing all this, but it's what you got to do. So with that all said, where do we put our marginal savings dollars, right? We finally got to the question. And most places, that aren't just complete crank, they pretty much will all tell you the same thing. And this is kind of it right here. And I don't really disagree with the basic conventional wisdom on this, right? The first place you want to put marginal savings dollars, right? So the very first time you get out there in the world and you make it enough money that you can save, where should you start putting that first little chunk of savings? That's what it was meant by marginal savings dollars. So that first chunk of savings, you put it in an emergency fund. And the goal of that is just liquidity, right? You want to make sure that wherever you're putting the money, first and foremost, you can get it out at the snap of a finger instantly, no penalty, no delay, no whatever, right? And so a savings account is a usual vehicle for this. Back in the day, that was like a 0% proposition for most of my life. It has been. These days, you can get savings accounts with, I don't know, I think 3%, 4%, whatever, because the Fed's been jacking rates. So, that's not too bad. And so, yeah, you put your money in something like that. And how much should you put in the emergency fund? Typically, people say 3 to 6 months of spending, right? So figure out how much you spend on a typical month and then put 3 to 6 months of money into it. Obviously, that's kind of an arbitrary rule of thumb, but, you figure it out. And again, the idea here is just to have enough so that if you do experience an income shock or do experience a consumption shock, you can go into the emergency fund to fill the gap. And then, once you're out of those shocks, hopefully they don't last forever. Consumption shocks typically don't. Income shocks could. Once you're out of that shock, then you build the fund back up, right? So it's just like a little buffer of cash. But But once you've got that and you're like, okay, good, I've got 3 months in here, I got 6 months in, and I feel pretty good. I feel like I can paper over the shocks when they come. Then the next place you're putting the next chunk of savings, the next marginal savings dollar, is in employer-matched retirement accounts, and really anything the employer matches, because an employer match is like an immediate 100% return, or whatever, usually they do it as a 100% match, but they might do it as a 50% match or whatever, in which case it's a 50% rate of return. So what does that mean? So an employer will have a 401k, which is a retirement plan, and you put your money in it, and when you become old, you can take your money out of it, right? And it generates returns in the meantime. Well, they'll have a plan that says something like, hey, for the first 5% of your salary that you commit to putting into the 401k, I will match 100%. So you put $5 in, I will put $5 in. You put $10 in, I will put $10 in, up to the limit. And usually the limit is expressed as a percent of your salary, which that's also kind of goofy. But you want to match that because it's just, that's, you get 100%. If they do a 100% match, you get an immediate 100% return. And then on top of that, with the 401k, you get a tax deduction, right? Because you don't have to pay the money that you put into the 401k in a given year, you get to deduct from your taxes. So let's say your tax rate's 25%. Let's say the employer is doing a 100% match right off the bat. You're talking about like 125% return just in year one. And then you've got the return from the account itself. Because you're going to invest it, and that return is not taxed, at least not until you retire. And you can go into there's some complications around all that, but that's the basic gist. After employer-matched retirement accounts, usually they'll tell you do the high-interest debt. And really what we're doing here for 2 through 6, not for 1, but for 2 through 6, this is just the list in order of highest return. Right? So after employer-matched retirement accounts, your highest return is typically going to be high-interest debt like a credit card, because those might have like 30% interest rates on them. So every dollar you put towards them returns 30 cents. It's a 30% rate of return effectively. And it's a guaranteed 30% rate of return. And it's a non-taxed 30% rate of return, right? The interest savings, you don't pay tax on it. So to match that level of return in a normal account, and with that level of certainty, right? Because there's no risk. You know that you're going to save the interest that you're going to save. You don't know that you're going to get the return on a stock or whatever, but this is certain. It's very, very difficult. So, you would pay off your high interest debts for the next tranche of money. Then you do other tax advantage accounts like your IRA, which is just like a 401k, except you open it yourself at a financial institution, so it's not done through the employer. Personally, I would get rid of 401ks and only do IRAs. It's kind of crazy to me that shit exists at all. Yeah, but whatever. We have these two parallel systems. And then you could do 529. That's supposed to be like college savings accounts. If you have a kid, you can technically use it for other things. And you'll find some personal finance bloggers on here being like how you can hack the 529 to use for retirement, shit like that. For the moment, I'm not really into the sort of extreme how to take advantage of these tax advantaged accounts shit, like, the mega backdoor Roth IRA and shit like that. That stuff's interesting, and it definitely shows you how absolutely fucking stupid our system is, but, not for this video, maybe for a future one. After you do other tax-advantaged accounts, and the reason you're going to do these tax-advantaged accounts, again, is because if you get to deduct the money that you put on the taxes, or on the flip side, you're not paying tax on the return, that's just going to beat other options typically. But then you would go to low-interest debt. That might be student loans, that might be a car note, that might be a mortgage, and you got to look at the interest rates on this, right? If you have a car note that has a really high interest rate, then that's a high interest debt thing, right? If the interest rate on that is higher than you would expect to get from an IRA or a 529, especially on a risk adjusted basis and on a tax adjusted basis and all that kind of shit, then you should do that. So finally we have the taxable brokerage account. So if you somehow you have a full-blown emergency fund, you've maxed out your employer match, you've paid off all your high interest debt, you've maxed out your contribution limits for your IRAs and 529s, or you've matched, like, it just doesn't make sense for you to put any more money in it because you're already set for retirement or whatever. And you've paid off your low interest debt, or, it just depends. Again, if the low interest debt is super low interest, like I have a 3% mortgage, I'm never fucking paying that off. Like, are you come on. If you have once you've done all that and you still got money, you're still like, shit, man, I'm just rolling it. I got so much cash. I got more places to put it. Then put it in a taxable brokerage account. That's the same thing as 2 and 4. It's the same thing as those other accounts. It's just that you don't get an employer match and you don't get any tax advantages. But it looks very similar, and you'll put the money in that account and you'll invest it in the same places that you invest those other kinds of accounts. It's just no tax advantages, no employer matches. And for most people, you'll never get to 6. I don't get to 6, and I make decent income. So, like, now maybe if you're older, or, or you inherit a lot of money or something like that, then you might need to go that route. But most people, if you've got money in a taxable brokerage account, you're either super rich or super stupid. Not stupid, but you don't know what you're doing about how to allocate marginal savings dollars. Okay, so when you put your money in these accounts, the retirement accounts, the 529s, the HSAs, all that kind of shit, where it's just like the welfare accounts, the welfare buckets, you are expected to put that with an account at a particular asset management company and then invested in particular assets. And these are separate things, right? Each asset management company, whether it's Vanguard or BlackRock or Fidelity or State Street or whatever, all those companies, they just have an account where you put your money. But then once the money's in the account, you still have to invest it in a particular asset. And these are separate things. And this is something that I've noticed has caused a lot of confusion. I'll talk to people sometimes that I know, and they'll be like, oh, I have my money in Vanguard. And it's like, what? You don't just, I like to put it in Vanguard. I switched it from Fidelity, and it's like, no, but what is it invested in? You don't invest it in the asset management company. They just run the account. The account then has to be invested in other assets. And any asset management company, for the most part, you're going to be able to invest in any assets. They all have access to all the same assets. It's just, again, they're account managers. Now, for employer-administered accounts like a 401k, you're not going to be able to choose your asset management company. For other accounts, you will. Also, I should clarify here, again, to be basic, 401k is what these kinds of accounts are typically called. In the nonprofit and state level, I think they're called 503Bs. And then at the federal level, like if you're an employee in the nonprofit or a state employee, and then at the federal level, it's called the TSP, the Thrift Savings Plan. But it's all the same thing. For other accounts that are not your employer-administered accounts, you will get to choose an asset manager. Like I was saying before, you got the big three are Vanguard, State Street, BlackRock, and then, you have a variety of other, more kind of retail, consumer-oriented places like Fidelity. Long story short on that, use Vanguard. I can go into the specifics of that more if you want, but just use Vanguard. As far as what particular assets to invest in, so once you got your money into the Vanguard IRA or into the Fidelity 401k or whatever, now you got to take that money and buy an investment with it. What you want to do, basically, in almost all cases, is buy shares of a low-fee target date index fund. If you don't know what that is, I can go into that more on another video if you're really interested in that. But, just Google Vanguard target date index funds and you'll see what that looks like. Low fee is important because you don't want to be losing your return to fees that the asset manager is charging. And the short on the target date index funds is, rather than you having to pick individual stocks and individual bonds and having to decide what portion of my portfolio do I want in stocks and what portion of portfolio do I want in bonds and how do I want to change that over time and do I need to rebalance it, all that kind of shit, which no one wants to fucking deal with. the fund itself is set up to manage that. So I'm invested in target date index fund for 2055, which is around the year that I expect to retire. So if you go search Vanguard target date index fund 2055, you'll see where most of my money is, and all that is this like little shell. It's just this little wrapper fund. That's how I think about it. Where you get full exposure to all the stock and bonds pretty much in the world, and they manage your ratio of stocks to bonds, and they manage it over time so that you're, taking on the sort of most expert recommended appropriate level of risk, meaning you're in high risk assets when you're young, but as you get older, they bring you into lower risk assets. That's the short of it. And you can even do the target date index funds for 529 education accounts. Is just the target date. It becomes when the kid is of college age, not when retirement is around the corner. So, yeah, in most cases, just open the Vanguard account and get a low fee target date index fund for your retirement, for your education, or whatever. I'll end the video here with pitfalls to avoid. Like I said, this is a jumping off point, so I'm happy to elaborate. I'm happy to do anything. Leave comments. I can make videos based on questions people ask. But in my view, here are some major pitfalls to avoid. One, do not buy individual stocks. Don't do that. Buy the index funds, where you basically, the way the index funds work is you end up effectively through, a variety of layers of financial wizardry. You end up owning all the stocks, just tiny little chunk of all the stocks that are out there. So you just accept the return of the market. You're not trying to pick individual companies that you think are going to do very well. You're just saying whatever the return of the overall market is, I'm good with it. And the reason you don't buy individual stocks is because you don't know what the fuck you're doing. Like you're not a company analyst. Even the people who do know what the fuck they're doing mostly suck at it. Like most people who, even with their job is to pick individual stocks, the research shows that they mostly do not beat people who just accept the return of the market. And then when you factor in the fact that buying individual stocks comes with a lot of fees, a lot of transaction costs associated with them, then you're sure as hell not going to beat the return of the market that through a product that has a low fee. So don't do that. Number two, do not buy cryptocurrencies, NFTs, gold, collectibles, etc. Waste of your fucking money. That shit can be very difficult to sell. Crypto and NFT is basically just like a pump and dump speculative scheme. Gold, can go up and down, and, collectibles, but even that shit can be very difficult to sell, especially collectibles. Gold, depending, if you buy it in an abstracted form, like in an account, I guess you can sell that reasonably easy. But this is clown shit. Don't mess with this. Number three, do not buy homes to flip them or rent them out. For whatever reason, there's a non-trivial number of personal finance guys who are real focused on you got to buy real estate, you got to do it. And obviously there are people who make good money flipping homes and renting them out, but that's like a business, and there are also people who make good money opening a restaurant, and people who make good money running construction company, but that's probably that's not you. Like maybe it is you. Maybe you are someone who's just like, I'm good at construction. I'm good at being a real estate broker. I'm good at property management and all that kind of stuff, right? If you were just like, I want to get into this because I think I would be good at this business, just like someone might say, I'd like to open a bakery because I'm a great baker and I'm a good salesperson and all that kind of stuff, then fucking have at it. But it should not be seen as the same thing or an alternative to putting money into like a 401k or something like that. Like, oh, this is my alternative. That's no. Like, unless you are just good at this particular type of business, you're making a bad decision. Number four, do not buy an unaffordable personal residence. Most people, if they have decent money, they want to be an owner occupier in their house. That's fine, whatever. I'm that. It's a little overrated, frankly, but the big thing on there, I would say, is when you go and they're like, oh, you're approved for a loan for $300,000 or $400,000 or whatever it happens to be, don't just be like, all right, cool, I'm going to get like the maximum amount. It's quite the opposite. You want to get like the minimum amount of housing that you feel good about, So otherwise, the thing with the housing payment is just very difficult to reduce. Other stuff in your life, if you hit an income shock or consumption shock, not only do you have the emergency fund that you can rely upon for liquidity, but you also can reduce other kinds of spending, right? You can buy cheaper groceries or stop, buying Uber Eats. You can turn off the lights. I don't know, conserve water. Most of the stuff you could do, drive fewer places, do less like entertainment stuff. Like there are things you can do to really cut back. You can't cut back your housing payments, so you're just increasing your risks by increasing your fixed costs, I guess we would say, as opposed to variable costs. And one of the nice thing about these variable costs is you can dial them down if you need to, but you can't do that with your housing payment. Number 5, do not pay for private K through 12 education. In a country like the U.S., realistically, the public schools are so good. I know people people give you shit for this. Like it's somehow conventional wisdom that this is not true. But just objectively in the world, they're so good that it's difficult to beat them, which is not to say it's difficult to match them. Plenty of, alternatives, whether they're, charter schools or some private schools and whatever, plenty of them can match the public school. But, it's just, look, they're full-blown schools with educated professionals who have degrees that teach and are taught, in education grad programs and stuff like that, how to be decent teachers. They have books and supplies and, good facilities and all that kind of stuff. Like it's not like a dirt one-room hut or something like that. And so just realistically, and then a lot of the factors that go into being educated, like becoming a good student or whatever, are not school side factors. They're home side factors. And people confuse this, right? So, I think you're wasting a lot of money if you're going to go out and be like, I'm going to spend $20,000 a year on K through 12 education. Add that up. Think about that for a second. That's 13 years. That's $260,000. If you want to help your kid, put that money in a trust for them. If you put $20,000 a year into a trust for your kid starting at age 5, and you had that trust invested or whatever, I know you do the math, and by the time they're graduating college, that thing's like at $1 million almost, maybe less. I don't know how the taxes all work, but I don't know. Let's say it's $700,000. Would you rather your kid, go to public school and get $700,000, when they graduate college, or would you rather them go to private school and get nothing? From a pure, I love my kid and I want to maximize their life chances, $700,000 in your mid-20s as a kind of base to start it's obvious. So, that's my view. Now, there are exceptions, obviously, if you're really interested in religious instruction or something like that. I get all that. But if you're like, man, I gotta get out of the failing public schools, you've drank the Kool-Aid, and you're kidding yourself, and it's not worth the money. Definitely not worth the money. So, like I said, hit me up with questions. I'd love to do more specific videos, but I think this is a good jumping off port for my overall vision about personal finance, which is that personal finance is a personal welfare state to patch the holes of our very shitty welfare state. And that's the best way to think about it. And, I guess this is the big takeaway is if you got the marginal savings dollars, allocate them in this order.